Alright, what's up everyone? Welcome to my channel. It's called Investing Sucks, and we talk about the part of investing that sucks. So in this lesson, we're going to be doing a video on 4 accounting standards that are important for value investors to know. Now, the reason I'd say specifically value investors is because these all have to do with calculating a company's intrinsic value, which is kind of the point of value investing. So I'm going to go over 4 different ones. They're all very unique in their own way. And without further ado, let's get into it. So the first one has to do with accounting for real estate assets. So as we know, companies will often purchase land and buildings that they could have their office on, or that they have stores on, or anything like that. Now, in certain instances, the value of those assets they purchase can increase significantly as time goes on if they hold them for a long enough time period. That can just be due to whatever microeconomic trends are happening in that specific area. Now, accounting standards require that land always be kept on the financial statement, so on the balance sheet, at whatever cost the company paid to acquire it. And then with buildings, it's the same thing, except there's also depreciation recorded on buildings, because generally buildings are said to lose value as they kind of age and there's wear and tear on them. But that's not always the case. Sometimes, if these assets are in specifically well-placed areas, they can increase in value significantly. So this is what's called hidden value. And this is something that value investors look at pretty significantly, because if you can find a company that has real estate holdings alone that is worth more than their current market cap, you could, in theory, purchase the company for its entire market cap, and then just sell those assets, pay off all liabilities, and then return the remaining cash to the shareholders, and then you'd make money. So a great example of this is a company called Tiffany's. So as it says here, there's kind of a story that this article, this is from Forbes, they went through where there's a son talking about his dad who used to commute to work in the 1970s. And basically what it says is this guy's dad discovered that Tiffany's market value at the time was $30 million. A quick calculation suggested that real estate was worth more than the company's entire market capitalization because they had this very iconic building in Manhattan. So this is a great example of hidden value, because this wouldn't have appeared on the financial statements just because of accounting standards. You can't write up the value of any type of real estate assets if we're talking about land or buildings. It's only when it eventually gets sold that you realize that value. So this is something that a prudent investor can look towards, and is really a great learning tip for people who are interested in value investing. Okay, so number 2 has to do with accounting for treasury stock. So what treasury stock is it's when a company repurchases its own shares. So we know that share repurchases have become very common in the business world in the last few decades. It's kind of a different way for companies to return cash to their shares, other than just to their shareholders rather, other than just paying them a straight dividend. So basically what they do is they go into the open market, they purchase shares back at their own shares, and they can either retire them or they can just hold on to them. And usually companies will do that if they think that their shares are undervalued. So the reason that this is significant is because the accounting method for this requires a new account to be created called treasury stock. So what I'm looking at here is the financial statements for Berkshire Hathaway. So Berkshire Hathaway, they do a lot of share repurchases. They've been doing it for a while now, and pretty much every month they're repurchasing their own shares. And if we look here, we can see treasury stock account. It's on the shareholders' equity section of the balance sheet, and it's a significant negative balance. It's about $39.5 billion. Now, the reason this is significant is, say you're a value investor, you're calculating a company's debt to equity ratio. This is significantly going to increase that debt to equity ratio because it reduces equity, right? That makes sense. And if you're looking at 2 companies to see how leveraged one is in comparison to another, if one company is engaging in a lot more share repurchases where they're repurchasing their shares at a cost that's higher than the amount of money they received when they issued them initially, whether that was a long time ago, because that cost is now higher because the shares increased in value, it creates this large negative balance on the balance sheet, which is called treasury stock, because when they go and repurchase it, they're paying a lot more than what the common shares would be stated on their account here, so the common stock account. Because as you can see, the common stock account is only $8 million versus the treasury stock account, which is accounting for all these share repurchases that they've made, is significantly higher, and that's because they've repurchased shares. So the main thing you want to note here is just the impact that it has on the shareholders' equity section of the balance sheet. Okay, so number 3 is contingent liabilities. Now, this was something I touched on briefly in a recent video. So a contingent liability is a liability of uncertain timing or amount. So a company has a present obligation, but they don't know exactly what the amount will be. So an example could be a warranty obligation, but a better example is a litigation or a lawsuit that a company is facing. They could be held liable for a significant amount, but they don't know exactly what that amount is at present time. Now, accounting standards say that companies only need to include this as a liability on their balance sheet if it is probable to occur, meaning the odds are above 50%, and the amount can be reasonably estimated. So if both of those two criteria are not met, then they don't actually have to include it as an expense on their income statement and as a liability on their balance sheet. So obviously there's a lot of interpretation here, right? It's really up to the company's lawyers to make these determinations, whether something has a probable chance of occurring and whether or not it can be accurately estimated. But I'll give an example here. So this is Google. This is their annual report. And obviously Google is engaged in a lot of lawsuits, right, with the Department of Justice and antitrust lawsuits. But one example I'm looking at here is with Oracle. So it says in 2010, Oracle brought a copyright lawsuit against Google, and then it kind of just details the nature of the lawsuit. But what it says down here, which is important, is that we believe this lawsuit is without merit and are defending ourselves rigorously. Given the nature of this case, we are unable to estimate the reasonably possible loss or range of loss, if any, arising from this matter. So that's kind of what I was talking about. They can't estimate what it's going to be, so they're not including it on their financial statements. So this is kind of a hidden liability, because in the future, if they are held liable for this, it could lead to a significant loss. Now, granted, this is Google we're talking about. They are a huge company with plenty of free cash flow. This lawsuit probably wouldn't hurt them that much, but for smaller companies, there could be significant lawsuits against a company. The only way you're going to learn about them is by going to the notes and reading this section here to see where it details it, because they are required to disclose it. They don't have to disclose it if the likelihood of them being held liable is remote, meaning it's very, very unlikely. But if there's any likelihood other than it being remote, then they have to disclose it. But unless it's probable and unless they can reasonably estimate it, then they don't have to include it on their financial statements. Okay, now the last one is non-recurring items. So this is a pretty simple one. When companies report their income statement, they have to include their income or loss from operations. So I'm looking at Shopify here. I did a video recently on Shopify, so I'll zoom out a bit. We can see their income or loss from operations was 90 million. Now, as required by accounting standards, they have to have a section here called Other Income. And in this section, we see an unrealized gain on equity and other investments for $135 million. You can see that right here. So this significantly boosts their net income, and it's an unrealized gain. They haven't sold this investment, they just have to increase the value because that's what they're required to do by accounting standards. So their net income overall is $320 million, but $135 million of it is just from that one-off item of the increase in the value of that investment they made. So as a value investor, when you're looking at earnings, you need to look at quality of earnings and make sure that all these non-recurring items, whether it's a write-off, a one-time write-off, or a one-time unrealized gain such as this one, you need to make sure they're excluded so you get a better picture of what their earnings are. So anyways guys, that's the video. I hope you enjoyed and I hope you learned something. If you did, again, I'd really appreciate you liking the video and subscribing, and I'll see you in the next one.